But let's get into it. So the fundamental numbers of business. And I split them into two categories. The first category is the income figures. And these are the ones that most people tend to get a basic idea of. The first one, I'm going to start in the top left-hand corner of my little pie here with the sales. So sales, you might call it revenue, you might call it income, you might call it turnover. All those names are effectively the same thing. So when we're talking about sales or we're talking about turnover, most cases they're pretty much the same number. And sales is the number that a lot of people do focus on. And certainly without sales, you don't have an income. There's nothing coming in if you haven't got any sales. So it is an important number to look at. But as another number that is equally important is your cost of sales. And I believe that every business has cost of sales. Accountants traditionally have often produced figures that have income less expenses and basically put everything in expenses irrespective of what it is and where it might really belong. And I believe that's wrong. That if you have a service-based business and what you're doing is selling time, whether you sell it on an hourly rate or whether you value-based price, you're still selling people hours, to be politically correct. And the cost of those employees, contractors, consultants, call them what you might, those costs, including all their add-on costs of workers' comp, superannuation, leave entitlements, possibly mobile phone or cars, all those types of things, if those people are delivering your services, then they belong in cost of sales, not as an expense. For the businesses that are selling products, it's straightforward. We all know if you have a retail shop or an online store, you buy your products, you sell them with some number above, hopefully, the price you're paying for them, and you've got that's where your income's coming from. And your sales less your cost of sales is your gross profit. And I'll go into a little bit more of that in a minute. From the gross profit, take off your expenses to get the net profit. And your expenses should then be all the normal overhead expenses. It might be your rent, electricity bills, bank charges, cleaning fees, repairs and maintenance, computer expenses, subscriptions, those types of things all fall into expenses, which create then your net profit. And the other figure that is vital in these, which again a lot of people don't think about and don't think about through the year, is the dreaded income tax. And yeah, I know, if we can get away without paying any income tax, that'd be fantastic. But really, if you've got a profitable business and you're making money, you should be delighted to be paying tax because it means you're making money and you've got all that after-tax money to take home and do with as you wish. So income tax, unfortunately, it's a bit like births and deaths. It's here. It's going to happen to us one day. We're going to have it. And it's important to be conscious of the income tax liability that's arising through the year and not wait for your accountant to give you a number potentially 6 or 9 months after the end of the year when you sit down in a meeting with your accountant and they say you've got 20,000, 50,000, 100,000, doesn't matter what the number is, some number that's way too big and you don't have the money for it. That's not a good way to be running a business. You need to understand what your income tax liability is, and at the same time, you also need to be understanding what your GST liability and your PAYG withholding, that's the tax on your employees, if you've got employees, what those liabilities are, and keeping track of those as you go through as well. So I believe that the income tax is a fundamental number that should be looked at regularly, not just after the end of the year. So my next part of this is to look at the bit more nitty-gritty on the gross profit. And there's two sets of numbers here. There's a gross profit and a gross margin. And I do provide a bit more detail in page 56 and onwards in the book. But in simple terms, sales less cost of sales is gross profit. And that's a dollar value. That's a amount. Gross profit as a percentage of sales is gross margin. And now that's a percentage figure. And that's an important number to keep track on. So if you are buying your widgets for $1 and selling them for $2, you have a gross margin of 50%, and you've got a gross profit of $1. It's important to understand what makes up your gross margin percentage, what the percentage is, so that you can look at whether or not you've got some capability, hopefully, to increase that gross margin. Particularly important with consulting type businesses where you're selling time, because I've often seen that is a problem. I actually had an example, a client where they were plumbers, so they were tradesmen. They were quoting on fairly large jobs. They were kind of new construction jobs they were quoting on. And they were quoting their guys at, I think they were quoting them at $50 an hour. It's a few years back now. I think they were quoting them at $50 an hour. And they were going backwards. They were struggling. They had all sorts of cash flow problems. And we delved into it in detail, and we identified that when we added in all the days that they were entitled to, public holidays, annual leave, there was wet days, there was days they weren't working, there were all sorts of things that added into it. Workers' comp that was skyrocketing, specific penalty allowances and things, that they were actually paying something like $56 an hour. So they were losing $6 an hour for every employee that was on the job. So it's easy to get caught out, or it's easy to get caught out where you're only making a couple of dollars per hour and really not making the margin you should be. So the gross margin is a number that is extremely vital to making sure you're going where you want to be going. The other numbers in fundamental numbers in business are what I call the capital figures. And these are typically things that you'll see in the balance sheet, and they relate to in and around what's going on in your bank account. So the first set of figures is the debtors. Now, debtors is another word for accounts receivable. It's the invoices you invoice to your clients or customers where they pay you at some later date, whether that's 7 days, 14 days, 30 days, whatever your credit terms are. And unfortunately, in today's economy, many businesses pay much after the day's credit that you're actually offering them, so you don't get paid as quickly as you should be and would like to be paid. That money goes into the bank account when it comes in, and from the bank account, you're then paying your creditors, so that's your suppliers and all the expenses, wages also, tax and superannuation, so the tax is including GST, tax on wages, superannuation for your employees' costs, and those numbers are basically the other side of the income figures. So the income and expense figures, and then you've got your balance sheet figures, which are principally your debtors less your creditors, and tax and super, giving you whatever's going in and out of the bank account. So again, debtors is money going into the account, creditors and tax and super is money going out of the bank account.